Today, Canada and China have reached a preliminary but landmark trade agreement to remove trade barriers and reduce tariffs. By building this new strategic partnership, a strategic partnership for current realities, we're creating the stability and certainty that's needed for new investment and opportunities for our workers. In parallel, as the Vice Premier referenced, Canada and China now have the opportunity to work more closely together to strengthen the world's multilateral institutions. We have the opportunity in the agreement and the framework to work together to combat crime and bolster public safety.
Breaking. A major geopolitical and economic development is unfolding tonight, and it is already drawing intense attention in Washington and beyond. Canada's Prime Minister, Mark Carney, has announced a massive $1 trillion investment agreement with China. The scale of the deal and the timing of the announcement have taken many observers in the United States by surprise. Officials are now trying to assess what this agreement means for North American relations, global trade, and the balance of economic influence. According to official statements from Canada, the agreement involves long-term Chinese investment across multiple sectors of the Canadian economy. These include infrastructure, clean energy, advanced manufacturing, artificial intelligence, transportation, and natural resources. Canadian officials describe the deal as a framework that will unfold over many years, with funding released in stages rather than all at once. The Chinese side has confirmed its commitment to the investment, calling it a strategic partnership focused on stability, growth, and long-term cooperation. The agreement reportedly includes joint ventures, technology sharing arrangements, and large-scale financing for major projects across Canada, while many details are still emerging. The headline figure of $1 trillion has immediately changed the tone of global economic discussions. In Washington, the reaction has been cautious but clearly tense. The United States and Canada share one of the closest economic relationships in the world. They are each other's largest trading partners with deeply integrated supply chains in energy, manufacturing, agriculture, and technology. Any major shift in Canada's economic alignment naturally raises concerns about access, influence, and security. Officials in the United States were not publicly briefed before the announcement, which has added to the sense of being blindsided. Analysts warn that sudden moves of this magnitude can strain trust, even between close allies. While there is no indication of any immediate retaliation or policy response, behind-the-scenes discussions are reportedly intense. Canada's government has framed the decision as an economic necessity. Officials point to slowing global growth, rising competition for investment capital, and the need to modernize infrastructure quickly. They argue that diversifying investment sources reduces vulnerability and strengthens long-term resilience. From this perspective, the China deal is presented as pragmatic rather than ideological. China, for its part, continues to seek stable access to resources, technology, and overseas markets. Canada offers all three. Its political stability, skilled workforce, and vast natural resources make it an attractive destination for large-scale investment. Analysts warn that China's strategy often focuses on long-term positioning, rather than short-term returns, which makes deals like this especially significant. The size of the investment has sparked immediate debate. $1 trillion is larger than Canada's annual federal budget and represents a substantial share of its overall economic output. Economists note that even if the full amount is spread over decades, the influence attached to such capital cannot be ignored. Control over infrastructure, technology platforms, and resource development carries strategic weight. Security analysts in the United States are paying close attention to which sectors are included. Investments in ports, energy grids, telecommunications, and data infrastructure raise sensitive questions. While Canada has strong regulatory frameworks, analysts warn that oversight becomes more complex as projects grow larger and more interconnected. The announcement also arrives at a time when relations between China and the United States remain strained. Trade disputes, technology restrictions, and strategic competition have defined the relationship in recent years. Against this backdrop, Canada's move is being interpreted by some as a signal of strategic independence and by others as a potential point of friction within North America. Markets reacted quickly. The Canadian dollar saw increased volatility, and shares linked to infrastructure, construction, and energy companies moved sharply. Global investors are recalculating assumptions about Canada's economic trajectory and its role in global supply chains. This could mean increased capital inflows, but also heightened scrutiny. Public reaction in Canada has been mixed. Some view the deal as an opportunity to boost jobs, innovation, and long-term growth. Others express concern about dependence on foreign capital and the potential loss of control over key industries. These debates are not new, but the scale of this agreement has intensified them. In the United States, business leaders are watching closely. Many American companies operate extensively in Canada and rely on predictable policy alignment. Analysts warn that if regulatory standards, data rules, or trade priorities begin to diverge, it could complicate cross-border operations. Even small shifts can have large effects when economies are so deeply linked. The deal also raises questions about North American unity on global issues. Canada has traditionally coordinated closely with the United States on trade, security, and diplomatic strategy. A major economic partnership with China could signal a more independent path or simply a response to global realities. Interpreting that balance will take time. Analysts warn that the biggest risk is not the investment itself, but uncertainty around how it will be managed. Transparency, governance, and enforcement will be critical. If projects proceed smoothly under clear rules, confidence may grow. If disputes arise, tensions could escalate quickly. There are also implications for other countries. Allies in Europe and Asia are watching to see whether this deal becomes a model for balancing relationships between major powers. Smaller economies, in particular, may study Canada's approach as they navigate competing pressures. Environmental considerations are another factor. Large infrastructure and resource projects can accelerate climate goals if designed responsibly, but they can also create long-term environmental challenges. Canada's ability to enforce its standards will be closely examined, especially as international scrutiny increases. From China's perspective, the deal strengthens its economic footprint in a stable, resource-rich country. This could mean more secure supply chains and increased influence in global standard setting. Analysts warn that economic influence often translates into political leverage over time, even without direct pressure. For the United States, the announcement is a reminder that allies pursue their own interests, especially in a competitive global environment. While cooperation remains strong, alignment cannot be assumed. This could mean Washington reassesses how it engages economically with partners, not just strategically. Diplomatic efforts are expected to intensify in the coming weeks. Quiet talks, clarification requests, and coordination meetings are likely as all sides seek to prevent misunderstandings. History shows that early engagement can reduce long-term friction, but only if concerns are addressed openly. As more details emerge, the focus will shift from headlines to implementation. How projects are approved, who controls critical assets, and how disputes are resolved will determine whether this agreement reshapes global economics or becomes a cautionary tale. For now, the announcement stands as one of the largest investment commitments ever made between two countries. It highlights how quickly global alliances and economic strategies can evolve in a changing world. And the question for viewers tonight is this: in an era of intense global competition, can countries balance economic opportunity with strategic trust, or will deals of this scale inevitably reshape long-standing partnerships? The announcement of a $1 trillion China investment deal with Canada continues to send waves through diplomatic, economic, and security circles as more implications come into focus. While the initial shock centered on the size of the agreement, attention is now shifting toward what this deal could reshape over time, especially for North America's balance of influence and economic coordination. At its core, the agreement signals a major recalibration of Canada's external economic strategy. For decades, Canada's growth model has been closely tied to the United States, benefiting from proximity, shared infrastructure, and aligned standards. This new deal does not replace that relationship, but it introduces a powerful new pillar that could gradually alter priorities. Analysts warn that managing two economic giants with competing global interests requires careful navigation to avoid long-term friction. One of the most closely watched aspects is infrastructure ownership and control. Large-scale investments often involve ports, rail networks, energy facilities, and digital systems. These assets form the backbone of national economies and can influence trade flows for generations. Even when ownership remains domestic, financing structures can create dependencies that limit future policy flexibility. This could mean that decisions made today shape Canada's options decades from now. The technology dimension is also drawing scrutiny. Investments tied to artificial intelligence, data centers, and advanced manufacturing raise questions about data governance and intellectual property. Canada has strong legal protections, but enforcement becomes more complex when projects involve multinational partnerships. Analysts warn that technology cooperation can blur lines between commercial collaboration and strategic leverage. From a United States perspective, the concern is not only economic but structural. North American supply chains are deeply integrated. Automotive manufacturing, energy distribution, and food systems rely on predictable cross-border coordination. If standards, incentives, or strategic alignments begin to diverge, even subtly, it could increase costs and reduce efficiency across the continent. This could mean higher prices and slower growth over time. Trade policy alignment is another area of focus. Canada has traditionally coordinated closely with the United States on trade rules and dispute resolution. A deeper economic partnership with China may introduce pressures to accommodate different regulatory expectations. Analysts warn that balancing these frameworks without creating conflict will be challenging, especially in sectors like technology and natural resources. There is also a political dimension within Canada itself. Large foreign investments often spark debates about sovereignty, transparency, and long-term national interest. Provincial governments, local communities, and Indigenous groups may all seek greater involvement in decision-making. Managing these internal dynamics will be as important as managing international reactions. Financial markets are adjusting their assumptions. A sustained inflow of capital could strengthen Canada's currency and boost certain sectors. At the same time, increased exposure to geopolitical tension could raise risk premiums. Investors tend to reward clarity and punish uncertainty, and this deal introduces both opportunity and ambiguity. Energy markets are paying particular attention. Canada is a major exporter of oil, gas, and electricity. Chinese investment in energy infrastructure could accelerate development but also reshape export destinations over time. This could mean a gradual reorientation of energy flows, affecting pricing and long-term contracts across North America. Environmental implications remain central. Large-scale projects can support clean energy transitions if aligned with climate goals. However, they can also lock in carbon-intensive infrastructure if incentives are misaligned. Analysts warn that oversight mechanisms must be strong enough to ensure environmental standards are upheld regardless of investment source. On the diplomatic front, quiet negotiations are expected to intensify. The United States and Canada have long relied on behind-the-scenes dialogue to manage disagreements. This situation will likely test those channels. Clear communication will be essential to prevent misinterpretation of intent and to reassure businesses and allies. Globally, other countries are watching closely. The deal could influence how middle powers navigate competition between major economies. Some may see it as a model for diversification, while others may view it as a cautionary example of strategic risk. This could mean the agreement has ripple effects far beyond North America. Security analysts warn that economic ties increasingly intersect with national security concerns. Infrastructure, data, and supply chains can all become points of vulnerability in times of tension. While there is no immediate threat, long-term planning must account for worst-case scenarios, not just best-case outcomes. Public opinion will also shape the outcome. If Canadians perceive tangible benefits such as jobs, innovation, and improved infrastructure, support may grow. If concerns about control and dependency dominate, political pressure could rise. Managing public trust will be a key challenge for policymakers. For the United States, the moment may prompt reflection on its own economic engagement strategies. Analysts warn that allies seek alternatives when they feel constrained or uncertain. Strengthening economic partnerships, rather than assuming loyalty, may become more important in a competitive global environment. The pace of implementation will matter. A gradual rollout allows time to adjust, regulate, and respond to concerns. Rapid execution could amplify both benefits and risks. Transparency around timelines and conditions will influence confidence on all sides. As the headlines fade, the real story will unfold in contracts, regulations, and daily operations. The success or failure of this agreement will depend less on its headline value and more on how responsibly it is managed. This moment underscores a broader reality of the modern world. Economic power is no longer just about trade volumes, but about infrastructure, data, and long-term influence. Countries must weigh immediate gains against future flexibility. As viewers consider this developing story, one question stands out above all others. Can nations pursue massive economic opportunities without weakening the trust and cooperation that underpin regional stability, or do deals of this scale inevitably change the balance in ways no one fully controls?